This is Andrew Stotz of A Stotz Investment Research to discuss some of my recent academic-style research. This one I call Decoupling or Increased Correlations Across the Globe. Before we start, let's review my academic-style research format. I start with a question, then I review prior research, develop a hypothesis, select my data set, develop my method, and test and find the results. And finally, most importantly, is to advise how to apply this to improve investment decisions. So, action. So let's get on with the question. The first question is, what benefit can you get from diversification? When I think about diversification, I'm thinking about across the three major asset classes, number one. Number two, across the emerging and developed markets. Number three, across the 10 major sectors. Number four, across countries. Number five, across stocks. The second question is, does it add more or less diversification benefit now compared to the past? So let's go into the review section and look at some of the recent papers that have been written. This one was written in 2008 and the conclusion was mixed. They investigated the degree of global cyclical interdependence between 1960 and 2005. They looked at three groups: industrial economies, emerging markets, and other developing economies. They concluded that business cycles within the groups had converged, but became less synchronized between industrial economies and emerging markets. So the results were mixed. Franken Hess in 2009 found high correlation between emerging markets and developed markets assets. They investigated links between banks in developed countries and emerging market bonds, stock, and credit markets during the 2008 global financial crisis. Conclusion: there was no decoupling at the time of crisis. Liquidity and bank solvency measures had become more correlated with emerging market bonds, stock, and credit markets during that crisis period. So, markets are highly correlated. The next one in 2012 rejects decoupling. They looked at deviations from GDP trends rather than the actual GDP growth rates. And they looked at 1980 to 2008. They rejected decoupling in the years before the global financial crisis and concluded that business cycle interdependence had become stronger. So, highly correlated. The next thing came up was in 2012, this research rejected financial decoupling. So they tested decoupling in two ways. From 1993 to 2010, they looked at real decoupling, which they called sensitivity to business cycles and other economic factors such as GDP, and financial decoupling, which was sensitivity of emerging market assets, credit, equity, and foreign exchange returns, relative to a global market portfolio. They concluded that business cycles in emerging markets have gradually decoupled from developed markets. They rejected financial decoupling as they could see high and increased co-movement in emerging market assets. Conclusion was markets are highly correlated. The next one came in 2013, and this one looked specifically at Pullman and found high correlation between emerging markets and developed markets. So they looked at the US and Pullman GDP growth rate dependency on the underlying long-term GDP trend. They compared deviations from that long-term GDP trend. Conclusion: no evidence to support decoupling within the Polish economy, and it was well synchronized with that of the US, so highly correlated. So now let's move on to the hypothesis. First hypothesis is that there are diversification benefits due to a relatively low level of correlation to gain from investing in different asset classes such as asset classes, regions, sectors, countries, and stocks. Next, correlations will have increased over time in all the above cases. Those are our hypotheses, so now let's move on to the data. First, we collected price data for MSCI indices from December 1994 to September 2015. Next, we looked at indices for bonds, commodities, and world equities. After that, we look for equity indices for developed markets, emerging markets, global sectors, and countries. For the country-level correlations, we used a data set of about 27,000 companies listed anywhere in the world, beginning in March 2002 and ending in May 2015. So what was our methodology? First, we calculated the returns of the indices and the stocks. Then we calculated the pairwise correlation between asset classes, regions, sectors, and companies. Next, we look at the average correlation within each grouping. Now, for asset classes, region, and sectors, we looked at a 10-year rolling correlation. For companies, we calculated the 3-year rolling correlation as the data set spanned a shorter time period. So let's look at the first beginning of the results. The first is that correlation increased after the global financial crisis. Now, we can see a pairwise 3-asset correlation here of bonds, equity, and commodities, that the correlation has been rising from 14% up to 45%. Now, diversifying across asset classes still offers benefits because diversification or correlation is still relatively low, but it's not as low as it used to be and therefore less benefits. Now, you see that little dip in the chart? Let's investigate that further. First, we find that correlation was low during the stock market rise. So when the market's going up by almost 50%, which peaked in October 2007, the bond market wasn't going anywhere. And so we can see correlation falling. Of course, that's not correlation that we like. I would rather have my assets go up on the upside, but not on the downside. But that's very hard to get. So now let's look at the next area, which is here, right? So correlation switched to be very high and rising by February 09, which was the equity trough, right? So what we can see here is that the correlation was low just before the crash, but that it started to rise after the crash and at the bottom of the market. Now let's look at a couple of other asset classes. First, we can see equity and bonds are no longer uncorrelated. The correlation between global equity and global government bonds has increased to 35% from 3%, which is almost no correlation. Equity and bond correlations have shifted up, right? And the correlation between emerging markets and commodities has doubled to 62% from 34%. I'm interested in this correlation mainly because emerging markets are tied to the commodity cycle, such as coal and fuel, oil usage. So we see no major decoupling here. Now, correlation increased after the global financial crisis. What we can see is correlation between emerging markets and developed market equity markets has increased slightly to 87 from 77. So if we go up to the highest level, which is developed versus emerging markets, that includes all countries and all stocks, we can see now there's a very high level of correlation. And there was a pretty high level in the past at 77%. This implies increased financial integration and fewer benefits from diversification between emerging markets and developed markets if you're looking at blending an emerging market index with a developed market index. And they've always been highly correlated at this aggregate level. So no decoupling there. Let's look at the next one, which is across sectors, and this has increased massively. So the average correlation among the 10 major global sectors has risen to 79% from 53%. Diversification benefits across sectors have been drastically reduced since the crisis. And that's because this chart is moving up and they're becoming more correlated. Next, let's look at country-level diversification and see that it still offers benefits. What we can see is the average correlation across countries has increased from 36 to 55%. But at the country level, it's easier to benefit from diversification, even though correlation has increased. So no decoupling. The next chart is the one that I think is the most interesting one, and that is stocks. So we can see that correlations are rising between markets and big indices, and things are becoming more correlated. But what we can see at the stock level is this. Stock pickers can still diversify. The least amount of correlation exists between stocks. This is between your average stock. Though correlation among stocks tripled during the financial crisis, it's been decoupling since 2012. This means that a stock picker can still construct a highly diversified portfolio. So stocks have decoupled and have remained decoupled. So let's summarize what we saw. Asset classes have seen an increase to 45% correlation, which we would say is moderately correlated, but a very large increase. Developed markets versus emerging markets has been moved up to 87%, but it's always been high, and this is a small increase. Sectors have moved significantly from 53% to 70% recently correlation. So this is a high level of correlation, and it's been a large increase. Countries moved from 35 to 50%, so it's a very large increase, and it's at the moderate level of correlation. And stocks moved from 9 to 7, actually down, which is a low level and is a small decrease in correlation. So what actions can we take from this? How can we learn from this? Well, correlation has increased over time and except for individual stocks. Expect portfolios of indices to be highly correlated. So construct portfolios of stock to benefit from decoupling. So this is Andrew's thoughts, and I want to remind you to become a better investor. Know it first, get access to additional research and articles, and get a free membership and newsletter. Go to babinow.com/join. Here is a list of some of the research that we referenced in this paper. Have a great day.